everyone, and welcome to POLITICO Finance Summit, also from my side. My name is Johanna Dreek, and I have the privilege to moderate our first spotlight discussion at this year's summit. We will be taking stock of the recovery. With us to discuss are Irene Tinagli, the chair of the Econ Committee of the European Parliament, Maarten Verwey, Director General for Economic and Financial Affairs, the European Commission, and last but not least, John Berrigan, Director General at the European Commission's Department for Financial Stability and Capital Markets. All our panelists will be joining us online, so a very warm welcome to all of you. Before we start, I would like to remind our audience that you can ask questions using the Swapcard app. If you like to tweet about the session, please use the hashtag PoliticoFS. Now, the Eurozone economic recovery was stronger than most of us would have expected at the depths of the recession in 2020. We are back at pre-pandemic level in terms of economic output, and as we heard from the European Commission's forecast this morning, despite current headwinds, the outlook remains optimistic. So in an opening round, I would like to ask all of you, what was it that surprised you the most in this recovery? Perhaps, Maarten, you would like to kick off, also giving us a little bit of color on your take of the forecast this morning. Thank you very much.
Thank you very much, Joanna. Yes, happy to lead off on this. Now, I would mention two things specifically. The first one you mentioned yourself already. That's really the speed and the strength of the recovery. So economy has bounced back very, very strongly last year. So we have seen growth coming out of above 5% for the EU, despite lingering uncertainties. And indeed, as you mentioned today, we have released our forecast. And what we say in our forecast is, despite the fact that currently we're going to a bit of a soft patch, we believe that the underlying fundamentals for this recovery remain strong. So for this year, we projected after a bit soft first quarter, the economy will accelerate again. And for the year, we expect a very healthy growth of 4%. And then for the year after, still a growth of 2.8%. So these are very healthy numbers. And indeed, as you mentioned, the economy was already back at pre-pandemic levels in the third quarter of last year. And as a matter of fact, we expect that by mid-23, the economy will be more or less where it would have been in the absence of the pandemic. So that's one. So really a strong recovery. The second point I would mention is really the strength and speed, or the strength and health of the labor market. I think this is really the success story of this crisis. Because of the measures that have been taken, the impact on the labor market has been cushioned. And looking today, the labor market has actually fully recovered, and unemployment is below the levels that we saw just prior to the crisis. So overall, very positive. And I think one can say that this testifies a lot to the success of the collective policy approach that we have taken to this crisis, which was, I believe, fast, bold, but also well coordinated over every level of government and with the ECB. Thank you.
Thank you very much. Irene, would you like to share your views with us?
Yes, no, I agree with that. What surprised me was the unity with which the European Union addressed the crisis, provided responses that were very incisive, very well coordinated, and I think that the results that we are seeing today and that Maarten well explained, I think we should really learn from, sometimes we say we should learn from the mistakes, but sometimes I think we should learn from the things that went well. So when we, as a European Union, as a European institutions, we decided to act swiftly, united, in a very incisive manner, without waiting and see, which would have led us to wait at a distraction and then maybe intervene. But we intervened immediately with a strong response like the Next Generation EU. Then the recovery happened at a pace that was unprecedented in terms of speed compared, if you think about the last great financial recession. So I think this was a pleasant surprise, as something to learn from.
So what's your key lesson learned, John? We can't hear you, unfortunately.
Sorry, thank you. You want my key, thank you, Joanna. You want my key lesson learned or my main surprises? Maybe I'll mix them both up.
Mix them both, so I'll start with a surprise.
I will start with a surprise. I mean, I have two surprises, one on the upside and one on the downside from the narrow financial sector perspective. Mm-hmm. I mean, and they're both linked to what Maarten has said about the strength of the recovery. I mean, the upside surprise is, of course, that we didn't end up with the tsunami of non-performing loans that we feared we might have at the beginning of the crisis. And this, I think, was a result of what Irene said about the sort of speed and the sort of cohesion in the policy response that we took. So today, NPLs remain, lower than average, in fact, historically. And I think although there are signs that there may be something coming down the line, it's nothing like the sort of tsunami that we expected. So this has been a sort of positive surprise. I think on the negative surprise from a financial sector perspective has been the resurgence in inflation, linked, of course, in large part to disruptions in the global supply chain. Now, it may not persist, but of course, it does create certain implications for the financial sector. Positive in some respects, of course. You can argue that if interest rates rise to match inflation, then net interest margin of banks will improve, and that will be good for them. But of course, it may have implications for asset values as well. So these were the sort of upside and downside surprises that I had. I think the key lesson, again, from the narrow financial perspective, is that this time the financial sector was not part of the problem. This is the old statement we keep making, but was part of the solution. But even if it sounds a bit corny, it is actually very true. And it wasn't part of the problem because we put in place the necessary reforms over the previous 10 years. So the lessons I draw from it is that if you put in place the correct reforms and you persist with those reforms, and we're still persisting with them, by the way, we are not finished, then of course good things will happen.
Mm-hmm. Thank you very much. Now, I think there's a general agreement that given the strength of the recovery, the overall policy response so far has been a success. But let's take a closer look at the Recovery and Resilience Facility. Now, the funds started flowing last year, and Spain was one of the early beneficiaries. But now the Spanish government is coming under increasing fire over the use of its funds, with critics blasting the distribution of aid as low and arbitrary, with too little amounts spread across too many projects. Now, could I ask you, Irene, perhaps, do you think that this is domestic politics, or is there a need for greater scrutiny still? And what role, perhaps, do you see for the European Parliament in this regard?
Well, I think that an effort like these, the European institutions and especially the Parliament should avoid trying to micromanage the single measures in the single countries, because I think that what matters the most is the final outcome. And one of the strengths of the RRF, of the Recovery and Resilience Facility, is that combined, on one hand, the ownership of the member states, of the governments that lay down their own national plans, because of course every country has been hit differently, they have different priorities, and they know what could be the measures that best allow them to recover and to be more resilient. We are not all the same. At the same time, there is this close monitoring this path with targets and milestones that have been negotiated and are continuously monitored by the Commission. From the European Parliament perspective, the most important thing is to make sure that this vision that was the origin of the RRF, of the recovery facility, the idea of narrowing down the divergency, making sure that we are recovering, making sure that all the European resources, of course, are spent correctly, so that there are all the mechanisms in place, that the Commission is doing its job. So we talk a lot. We have this working group with the Commission, and we monitor the work of the Commission in implementing the regulation that the Parliament had negotiated with the Council. So I think this is the overview that we need to take, the European vision to make sure that these funds are gearing Europe towards a stronger recovery and a more resilient economy to protect the single market. Let's not forget, one of the main reasons that gave us the push to do the Next Generation EU is not simply, of course, it's also the solidarity to individual countries, but it's to protect the single market and the European economy. So this is the big effort that we need and the perspective that we need to have.
Okay, thank you. Maarten, what is your view? How happy have you been with the implementation? And perhaps could you also say, how impressed have you been with the national plans in general? Is there a particular one that you would like to highlight as especially ambitious?
Yes, no. Let me start by saying that I'm generally speaking very satisfied actually with the way that the plans have come out, and I very much agree also with what Irene has said before. I think what was very important in this process is also that the ownership of the member states, and we have gone through a very intensive process and very interesting process, but I would say also a very constructive process with member states in the discussions on their plan, on the formulation of their plans, and ultimately the approvals, and all to make sure that the commitments that were undertaken, that they were owned by the member states on one hand, but were also sufficiently clear to form a good basis for implementation later on. Now, you mentioned on specific plans. I can actually mention many plans, and now there are a number of very big plans which are, I think, very important also more broadly for the functioning of the euro area. And one plan to mention here is the Italian plan. It's by its size, it's super relevant. Also, the economy of Italy is super relevant for the eurozone at large. And if you look at that plan, that contains a very interesting mix of, on the one hand, reforms that I think everybody agrees were long overdue, but also important investments for which I think Italy did not find the fiscal space in the years before, and I think that bodes very well for later on. But there are many other countries that have done an excellent job in putting these plans together, and indeed, as you mentioned, we're now going to implementation, and yes, it is still early day, but I would say so far so good. Thanks.
Okay, thank you very much, John. I want to go back to something that you mentioned earlier in terms of the non-performing loans, because there have been ample warnings that all this money we're now throwing at the economy could feed a zombie economy that will then come back to haunt Europe in terms of non-performing loans wrecking the financial system. We haven't really seen that materialize yet, and you said earlier we don't really see too many indications of it yet happening. But I just want to understand what's your timeline here. Can we already celebrate, or when are you ready to sound the all clear on the non-performing loans?
Well, anybody who has the words financial stability in their title of responsibility, you'll know we'll never celebrate just because something hasn't happened. So we are paid to worry about things. I think I will repeat that our worst case scenario at the beginning of the crisis has not materialized. So this fear of a tsunami of non-performing loans has not. And indeed, as I said, the non-performing loan ratios are actually historically low at the moment. But there are signs there that there may be in the coming years a build-up of some increase coming forward. And that's to do with the stage 2 loans, which are still relatively high. So those loans which are not yet non-performing, but are moving towards the non-performing classification. So I think we shouldn't be complacent about this. I mean, we should be very thankful that because of the public policy measures that were taken and because of the success that Maarten has already mentioned in these programs, we have avoided the worst case scenario, but that doesn't mean we should relax. So I think it is important that while the public support measures are not withdrawn too abruptly, that they are now more targeted and that efforts are made to try to target them more at those entities which are viable and which are likely to survive going forward. I think banks themselves also can be more discriminating themselves in extending credit under guarantee or under moratorium to those that they expect to be viable. And of course, that I think will limit the risk of this zombification that is often mentioned. I think also we had an NPL action plan, which of course was designed for a much worse case scenario, but it's still there, and it still provides possibilities for banks to offload existing stocks of NPLs, which they have been doing, by the way, and continue to do through the COVID crisis. So I think, I'm very happy that we're not sitting here talking about an overwhelming of the financial sector through insolvencies linked to non-performing loans linked to insolvencies. But I think we still need to be a little bit careful, and just be careful that we're not replacing a tsunami with sort of a strong surge in the years to come. I hope not, but we will remain attentive to this.
Remain attentive. Does that mean you still think it's a significant risk, or is it more tail risk at this point?
As I said, I think it's not a risk of what we fear, like an overwhelming of the sector, but I think there is a risk that non-performing loans will go up again, and non-performing loans in the banking sector are a source of inefficiency. And so I don't think it's in any sense a stability risk, but there is an inefficiency risk linked to an increase in non-performing loans in the sector, and that has to be managed.
Okay. Could you also elaborate a little bit on what you said earlier in terms of the latest inflation developments and what impact that might have on banks and their capacity to finance the recovery?
Well, I think it will depend really on how persistent this inflation rate is, and Maarten's much better positioned than I am to talk about how persistent the inflation rate is. If I think it persists and interest rates need to rise in response to it, as I said, if you speak to most bankers, they will tell you that from their perspective, having positive and higher interest rates can help them in terms of their net interest margin, so their basic business model, which has been under stress, of course, in what has been a low interest rate for long environment. So I think that's an upside. But of course, as I said earlier, there are also downsides to having inflation in general in economics. And again, I leave Maarten to talk more about that. But there will be issues for the wider financial market and valuations, which might come down if we enter into a different interest rate environment. So again, I don't think we want to exaggerate the risks here, but they were not perhaps something I expected to be talking about as quickly as this. And I think it's more to do with the global supply chain than anything else. And hopefully that will rectify itself. And we'll not be talking about this again next year.
We hopefully have a chance to speak a little bit about inflation later on in terms of the risk it might pose to the recovery. Right now, I want to talk about the green recovery, Maarten. So, Europe didn't only want to have a recovery, but made it a priority that we would have a green recovery. How has Europe done on that front so far?
Yeah. Now, maybe to start with one observation, and that the COVID crisis actually started right after, or very shortly after, the Commission President von der Leyen had launched the Green Deal, and I have to say that has helped us a lot in terms of thinking on how to go about the crisis response. So right from the start, and because of the fact that we were already in the Green Deal framework, so you will, we have put a lot of thinking in ensuring that whatever we do in terms of crisis response was also going to contribute to, well, what then after has become building back better, and in this case, building back greener. So also for that reason, there is a provision in the RRF regulation that stipulates that at least 37% of the investments financed under the RRF should be classifiable as green. Now, in reality, this number is exceeded. So around 40% of all investments can be classified as green, and that translates in around 180 billion in additional investments, and this money goes to sustainable mobility, so electric railways, charging infrastructure, energy efficiency, so renovations, sustainable energy production, etc. Now, this is a very significant contribution, but let me also say immediately that this in itself is not enough to achieve the targets that we have set for ourselves for 2030. So from the Fit for 55 impact assessment, we know that we will need some additional 390 billion in investments per year just to meet the targets on the climate and the energy. Now, also to be clear, only a part of that will have to come from the public purse, but still it is a significant amount that is still going to be needed. So yes, I think we've done a good job in targeting these investments towards the green, but it's also clear that this in itself will not be enough. Thanks.
Irene, what's your sense, and do you think we can look back and claim success on this being a green recovery if we have a taxonomy that includes fossil fuels?
Well, I wouldn't mix too many things. I mean, the investments that the member states are carrying on, also thanks to the Recovery and Resilience Facility, the support that they received and that they are directing towards the sustainable investment, sustainable transportation, efficiency, renovation of all the housing, social housing, etc. It is very relevant, and I think it's really giving a strong push in the right direction, something that we should probably have been doing much earlier, but it's always welcome. Of course, Maarten said, I think I would also underline the fact that we will need much more resources for the future, and also, let me say, for longer. I mean, Recovery and Resilience Facility Next Generation EU, as you know, is temporary. Will finish, the allocation 23 and the full implementation 26. But of course, we will not have completed the green transition by then. So we will need to have in place the instruments to support this transition and these investments. So the idea of also having the private sector, the public sector, public investments will still be needed, and that's why I believe it's important also the debate around the economic governance review that it's going on in the union, and I think we need to think in terms of this, how to create the space to support As I said, I always say that rethinking the economic governance is not a matter giving flexibility to someone that needs it, but it's a thinking about the European priorities for the future, how to build, how to complete this transition and how to make the investments. And then, of course, also support the private sector because we can't do everything only with public investments. So we are trying to do it. We have several proposals. We have, we have the green bonds. The taxonomy is an instrument. I don't know now in which capacity I should speak. I was not. I was hoping for, let's say so. I was hoping for a slightly different approach to that, but I think it's still an instrument that gives transparency because, and this is what is needed. It provides with standards. It provides transparency because now every product should be very clear about where the money goes, so the investors can choose responsibly and with awareness. And then, of course, we will need much more. I mean, if you get me started with the completion of the CMU, and, I can get on for an hour. But it's
unfortunately, we don't have the time for that. John, but if I can get back to you, the banking sector also does not seem quite ready for the green recovery yet. In November, the ECB said that not a single bank was close to meeting supervisory expectations in terms of incorporating climate-related risk. And you yourself said that supervisors should make full use of their mandates and powers to ensure that risks are provisioned for adequately. Could you elaborate a little bit on what you mean, what specifically they should do beyond what they're doing already?
Yeah, I mean, I think first of all, the first thing to say is that, I mean, we're in a sense, we're all starting from scratch here. I mean, with this, if you go back 10 years ago, we were nowhere in where we are now in terms of sustainable finance agenda. So everybody's having to almost start from a stop and pick up speed very quickly. So it is true, of course, that the banks are not where everybody wants them to be, but I think they are making progress, even if they have to do more in the future. I mean, what we have done so far for the banks is, we already have put into law an obligation for the larger listed banks to disclose all of their ESG risks. So, and we just received, by the way, templates from the EBA, which is we will adopt in the coming months, and that's going to help them to do that. So already they have a requirement to provide information to the public on how their own climate exposures are and how they're managing those exposures. So there's a start there. And then in the banking package, we have also included a requirement that they have to integrate ESG risks systematically into their management processes. So this is not yet adopted, but they know it's coming, so they will be starting already to prepare for it. And then third, as you mentioned, I mean, the central banks themselves and the supervisors within the central bank community are very active in trying to understand and measure the financial stability risks linked to climate and how to help banks manage those risks. But I have to be honest with you, we don't, even as supervisors and as regulators, have a full understanding of how those risks actually impact on a balance sheet and what is the most efficient way for a bank to react to them. And we have asked our agencies, our authorities, to help us in that regard. So I'm not going to be able to tell you today what I think a bank needs to be doing more or what a supervisor needs to be doing more, because in a sense, we are all learning by doing. But I can tell you that the evidence already now, if you look at the evidence now, it is that the large international banks are already factoring in climate risks. They may not be where we all want them to be, but they are factoring in climate risks in their management processes. But there's more to be done. But I think we also have to look a little bit more at the smaller banks as well, because the smaller banks who are even less advanced, and this is perhaps the more concerning, they are typically less diversified. They are more exposed to localized impacts from physical risks, etc., and transition risks they need to pick up. So I wouldn't be as I think the ECB are right to say what they say, that they are not where we want them to be, but I wouldn't like to get the impression that nothing has been done so far and that the banks have made absolutely no progress. They have, but we need them to make a little bit more.
Mm-hmm. Now, looking a bit further ahead, Irene, and I would ask for a fairly short answer with a view to our limited time. As you pointed out earlier, we are now having a lot of investment via the Next Generation EU, but the transformation of our economies will be far from complete when those dry up. So how can we ensure that the recovery is ongoing thereafter, and that we're not moving instead into the next debt crisis?
I think working on the 2-3 levels that I mentioned. One, reviewing the economic governance of the European Union in a way that it keeps us for the future, that allow for investments in the direction that we need, so to support investments to complete these 2 transitions. Second, to support the private sector and also the banking sector in allowing them to be actors that have all the instruments to be to operate and to attract investments. So, and we know these are the usual suspects. We need to make our capital markets union stronger, more integrated, to work to allow more cross-border activities and more, bigger banking groups, banking union, usual suspects. It is crisis management. We will all have this, some of this dossier in the spring. Some others we already have on our desk. We will be working on them so we can take advantage of some of these measures, like the review of the solvency, or, we have other issues regarding LTIF or ESAP. So many dossiers on which we are working to try to make the European markets stronger, more resilient, but also more attractive for investments. I can't be shorter than this.
Fantastic. Thank you so much. Perhaps a last closing round, a quick answer from all of you. What do you currently see as the biggest risk to our recovery? John, would like to go first?
I think, as I mentioned earlier on, and I'm not best equipped to talk about this, but I suppose if inflation proves to be more persistent than we expect, then I think there could be some issues from that. Let's hope that Maarten now tells me I don't have to worry, in which case I have no worries for the future. Thank you.
Maarten, can you take our worries away?
Well, obviously the risks are part of life, but if we look at the moment at the risk picture around growth, it's actually rather balanced, where we see a number of potential upside risks and a number of potential downside risks. But all in all, I think the dynamic of the economy is pretty strong. So for the next, bearing subject to really unexpected big events, we're actually quite confident that we will continue to see a rather strong recovery.
Thank you. Irene?
Well, yeah, rather than inflation, I would focus on the cost of energy, which is driving up inflation. I mean, the main component of inflation in these past few months has been energy costs, and this worries me because this is actually something that can create problems and hamper the recovery. I see many manufacturing countries are suffering from this. Small, medium enterprises are suffering, families are suffering, local administrations, local governments are suffering because the spike in prices of gas and energy is actually creating problems in providing basic services, and this could turn out in social problems. So I hope that I would like to see a European effort to address the energy prices as soon as possible, not underestimating the potential impact of this factor. And so I hope that there will be European measures on this and not leaving member states alone in dealing with this, because we thought it would be very temporary, but apparently it's not.
Thank you very much. So I guess this leaves us with a sense of optimism for an ongoing recovery, but also the warning that we can't be complacent, but have to work to ensure it's going to be green and lasting. So thank you once again to all the panelists for your time this morning and insights. The next session will start in a couple of minutes. It will address the question of whether Europe needs. I have the privilege to moderate that session as well, so please stay tuned. The audience in the room, please remain seated in the meantime. Thank you very much.